If you make good money, but it still feels like you're using each dollar every month, then this video is for you. This is based on a true story. Of course, we're changing some details for privacy reasons, but this is a 37-year-old couple. They work in tech and have a solid household income of $325,000 a year, and they spend roughly $165,000. So objectively on paper, it looks like everything is going well. But when they came to me, they told me that they don't feel like they're getting ahead. And when we looked at the data, it made complete sense why they would feel this way. So in today's video, we're gonna walk through how we alleviated some of their concerns, show a projection, and how that helped them better answer the question, are we on track to become work optional someday? Let's get into it. So what we're looking at here is this couple's element scorecard. This is the objective set of measures that I'm going to look at for each client. Really helps me as a certified financial planner gain a better understanding of your situation on a more holistic basis, just in this snapshot here. And then we can click into the various elements and learn a little bit more about where specifically they might be saving money or what their debt rate might consist of. So like we mentioned at the beginning of the video, this couple's doing a great job, $325,000 a year of income, a little over $165,000 of spending. So what I want to do first is direct your attention to what I call your cash flow row, because there are four main places that you can spend your money. You can save it, you can spend it, it can go towards debt, or it can go towards taxes. So when it comes to this couple, if we click in, let's take a look at savings rate. So they're saving 20% of their income, and that's calculated by taking how much they're saving on an annual basis and dividing it by their gross income. So now, where exactly are they saving on a monthly basis? Let's click in and find out. As you can see here, their savings rate of 20% is made up because they're saving roughly $63,500 a year on that same level of gross income. And as we scroll down a little bit further, they're putting some money away to cash savings. For today, we're going to ignore this for the projection that we're getting ready to go into, but know that they're saving over $7,600 a year, just building up their emergency funds and liquid cash savings. So this is really important to note. Where it says stock option here, we're really talking about restricted stock units or RSUs. A lot of my clients will get paid in stock via these RSUs, and whenever they don't get sold immediately, what happens is that's money that you don't really see. You're getting granted these shares on a quarterly basis, semi-annual basis, depending on your particular vesting schedule. And if you're not spending that money immediately, then effectively what you're doing is you're taking income. So in this case, as part of salary, $30,000 is coming in the form of these restricted stock units. And since in this example, this couple isn't spending those, that actually gets added to savings rate. So they make 30 grand because that's their compensation, and then they're saving roughly that $30,000 as well. They're not touching it. So that's one reason why in this particular case, they felt a little bit more anxious or stressed about their money, didn't feel like they were saving very much. And a big reason for that is due to the fact that they're not touching these RSUs, and those are automatically getting counted towards savings. And again, a good chunk at around $30,000. They're also putting some money into a Roth 401k, as you can see here. And then the final savings item today, about $21,500 is going into a 401k. So overall, just for context, a 20% savings rate at this level of income is very solid. Typically, once we see this number tick above 15%, that's when we start getting in the healthy category. And for a lot of my clients, I don't even suggest that they start budgeting, because as long as we're not seeing overspending, and in this particular case, not happening, and they're automating their savings and investing, which is exactly what's happening here, then as long as they're not overspending, like I mentioned, they're going to be totally fine. Their automated savings are taking care of their future selves, and since they're not overspending, they can enjoy life in the present and spend more money intentionally, and hopefully that frees them up to enjoy it a little bit more as well. Now moving on to what's called burn rate. Burn rate is going to be your spending minus your debt divided by your gross income. So as you can see here, their burn rate is at 24%. We typically see this number based on this level of income around 30 to 35%. So they're well under that, not having a spending problem here. We also look over at their debt rate. The majority of this money is going to be going in the form of a mortgage. Typically, again, giving you more context, whenever we see this number above 30%, that's when we start getting a little bit more worried. They're below the 30% threshold, around 27%. So unless this was made up of massive credit card minimum payments, which again, it's not, it's mostly a mortgage, then this isn't a cause for concern. But when it does come to debt, this is something that each couple, each situation could be a little bit unique. For some, they might be more risk averse, if you will, or debt averse and want to keep this number below 25% or below 20%. Each situation's different. This isn't supposed to be prescriptive advice, so your results may vary, if you will, and we just want to make sure that you have a debt rate that you're comfortable with, whether that needs to be lower. Some people might be comfortable with a little bit more too, but you just have to make sure that it's right size for your unique financial situation. And then also on the tax side, so they're roughly 25% of their income is going to the IRS each year. So as you can see here, this couple is doing fine from a cash flow perspective. They've got their savings automated, as you can see here. They're clearly not overspending, as shown by this burn rate. Their debt rate isn't out of control, and we do have some things that we're working on for this year to maybe even legally lower this tax rate by a little bit more. So overall, from a cash flow perspective, they're doing pretty well. Now, let's move on to the bottom row here, and we call that the wealth row. So there are a few main places where you can put your money to build and grow your wealth over time. There's liquid term. That's going to be your cash and your brokerage accounts, money that you can more quickly access. There's qualified term. This is going to be your retirement accounts, your 401ks, 403bs, IRAs, Roth IRAs, 457s. This is your retirement money. So typically there's going to be some level of penalty to access it before you're 59 and a half. It's simply not as liquid, not as accessible as money that's going to be in this liquid bucket. So that's why we call this one qualified term, qualified money. These are going to be your retirement accounts. You can also build wealth through real estate. In this particular case, they have a house, so they do have some real estate equity, some home equity, because they put a good chunk down for their down payment. Business term, this is only going to be applicable, of course, if you have business equity, you're a partner in a business, you have a business that you plan to sell in the future. And then what total term is, this is your financial freedom ratio. So we calculate this by taking your net worth, and then we divide that by your annual spending. And the difference of these two, in this particular case, a total term of 4.3 years suggests that if they were to sell all of their assets, which that's not, of course, what we're doing, and subtract out certain assumptions, taxes, inflation, fees, etc., they could live on current spending levels for a little over 4 years and 3 or 4 months or so. So typically, whenever someone can become work optional or they get closer to retirement, we want to see this number closer to 25, maybe to 30. Again, each situation is going to be a little bit different, but as you'll see in a moment, whenever we get to the projection, this total term score is going to be something that's super important, because if we're projecting out that your total term score is at 25 or 30 or 35, that's when we start talking about, okay, we need to put together a specific retirement income strategy at that point so that you can comfortably make work optional, retire, volunteer more, take a big pay cut and do something that you love, spend more time with grandkids, whatever that retirement goal ends up looking like for you. It's all about accumulating wealth and then turning that wealth into income whenever you do want to make work optional in the future. And with that, as you can see here, this couple overall is objectively doing very well. So again, quick reminder, the big reason why they didn't feel like they were doing as well as they thought really came down to this savings rate, because they were automating a lot of their savings. They didn't see it. It didn't come into their checking account and then they sent it out to their 401k or for their brokerage account for those restricted stock units. So with that, it didn't feel like they're saving 20% of their income. But when we do take a step back and look at their overall picture from a holistic basis, we can see that their savings rate is very good. And even the rest of their cash flow row, they're not overspending. Debt rate isn't at an extreme level, and taxes are going to be what the taxes are for right now. Try to trickle those down a little bit. But overall, their cash flow situation is great, which then begs the question, okay, that's good. We're saving a good amount of our income, but questions like, well, did we start too late? Should we still be saving more? Are we on track to become work optional? What potential years could that be? Are we talking 55, 60, 65? Am I going to be forced to work until I'm 70? So with that in mind, we've set the stage for where they are today. And now let's take where they are today and project out where we would expect them to be in the future. Before we jump into the projections, first, I wanted to share what the ultimate purpose of a projection should be. Because anytime that we're projecting out 20, 25 plus years in the future, we're having to make a lot of assumptions, and we know nearly for certain that we're going to get some of them wrong. So really the whole purpose of today's projection is to help this couple answer, are we on track, and do we need to change anything in the present? Do they need to cut spending a bit so they can increase their savings? Do they need to change their expectation on when they might become work optional? Do they need to make investment changes to get higher rates of return because they're behind, or could they be more conservative because they're ahead? So ultimately, the entire purpose of this projection is to help us decide either keep doing what we're doing in the present, or we actually need to make this change because this is what the projection told us. We're not running a projection for the sake of running a projection or looking at a cute spreadsheet. It should be giving us actionable advice in the present. So with that being said, I try to keep projections, especially this far out, as simple as possible, minimize as many assumptions as we have. So as we can see here, we are looking at the assumptions for today's projection. This NQ return is going to stand for non-qualified return. That's going to be the brokerage account. That's going to be RSUs. And I'm inflation adjusting the return because I'm keeping their income as well as their spending level. Now, we know over time, our income, even if nothing else because of inflation, should be trickling upward over time, as well as with that, we know that we're going to spend more money in 10 years likely than we are right now. So by keeping those steady, I'm factoring in inflation on the investment side. So that's why you're going to see much lower returns than normal because we're already factoring in inflation there. So all of the numbers that we're then going to look at today are effectively going to be in today's dollars. So if we see that their net worth at some point in the future is $2 million, that's $2 million worth of today, recording this video in early 2026, that has the purchasing power of $2026 effectively. Versus if you don't do any sort of inflation adjustment, $2 million in 15 years, likely not going to buy as much as it does today in 2026. So again, trying to keep things as simple as possible here. We've got a cash interest portion to this as well. You're also going to see this home appreciation. It looks like their house is going to appreciate by 8.5% per year, which would certainly be well above the average of 3 to 5%, which is what typical single family homes will appreciate over time. Of course, that's not a guarantee, but the reason why this number is much higher than that typical rate is we're also factoring in debt pay down. So every month that they're making principal payments as well as their interest, their principal balance is going down. Effectively, we targeted a long-term 3% return-ish of their overall real estate for their home. So that's why this number looks high, but really we expect their home, which is $1 million today, to be worth roughly $2 million in approximately 25 or 30 years. That's how we came to this number. And down here, we can see how much they're saving. Just under 26 grand is going to their retirement accounts, as well as another $30,000. Those were in the form of those RSUs. They're saving those on a consistent basis as well. So total savings is just under $56,000 per year. And like I said, since we're already factoring in inflation in the investment return assumptions, we don't need an income or spending increase down here. So again, just wanted to set the stage. We're making a lot of assumptions. Don't go into the comments and say, why didn't you use a 6% return versus a 4% versus 7? We can of course update all of those numbers, but really the key here is we want to keep it as simple as possible. With one of the big values of working with a certified financial planner is we're able to update and monitor this over time. So in 5 years from now, things will have looked different. We'll have been updating this constantly along the way to see if we need to make any updates to current spending, current savings in the present. So trying to keep it as simple as possible while still helping them feel more confident, gain clarity on when work could potentially become optional. Now that we've already shared about the assumptions and trying to keep things as simple as possible, while also understanding the true purpose of a projection, let's dive in and see where the numbers fall. So what we do know is where they're at today. So we have their current balance sheet, where their current money is being invested, how much cash they have, how much is in brokerage accounts, the retirement accounts, their real estate equity, and what their overall net worth is. So we know that, and we're using those assumptions that we just talked about to then put their future wealth, instead of just saying, oh, you're going to have $2 million in 10 years or in 15 years, we can say then we expect you to have that total term score, which remember is going to be your net worth divided by your annual spending, your financial freedom number, if you will. When that hits 25, we know that you're getting closer to become work optional. So we're turning your net worth into a number that's easily digestible. Because if you ask someone, is $1 million a lot of money? Well, if they spend $500,000 a year, that $1 million gets them 2 years worth of spending. But let's say that that same person spends $100,000 a year. That $1 million represents 10 years worth of spending. So that's why I love the total term score so much, because regardless of what the balance is, it all depends on your spending to help answer the question, is this enough? So that's what we're looking at here in the projection. Now, I know that we're looking at a lot of numbers. Don't get too caught up in the weeds here. Again, the goal is, are we directionally right? Do we need to make any changes in the present based on where we currently are and where we want to be? So I've highlighted a few years. So in 2038, they'd be 50 years old. We can see exactly where their net worth could potentially be. Again, there's no guarantees here. We do have to make assumptions, like I was telling you. So within 12 years or so, we would expect their total term to be roughly 13. So at a 13 total term at the age of 50, that's still not quite going to be enough to get them to retirement unless there's some other things that have changed in their situation. But let's take it out another 10 years or so, and that would get us to 2048 when they're 60 years old. They now have a net worth, and remember, based on our assumptions, that's just under $4.7 million in today's dollars, meaning it would have the equivalent of $4.7 million of spending power, 2026. And that gets them to a total term of above that 25 number, closer to 30. We're at a 28.4 total term. So even based on this projections, most people would be considered a slightly earlier retirement. Folks can't take Social Security until age of 62. So 60 would even be the number where you can start accessing a lot of your retirement accounts as well. So a lot of folks use that number as when they might decide to retire. And we can see at the age of 60, they would at least be having these conversations. Again, I'm not saying that we're going to run this one time and just completely forget about the plan and then come back in 22 years and say, oh, yep, you guys are good to go. Let's just retire now. We're going to be updating and monitoring this throughout the years, which I feel like I'm a broken record on that, but I cannot stress that enough, where we want to be directionally correct, have a good idea of where we might be, and then be doing this ongoing planning process to make sure that if and when we need to make adjustments, we're going to catch it sooner rather than just a truly set it and forget it type strategy. But at least from an initial projection standpoint, with how much they've already accumulated at their age of 38, what they're planning to save and invest on a consistent basis moving forward, they're in a pretty good spot. Look, I don't want to try to sell the projection that we're selling some sort of certainty. And if you just keep doing what you're doing, this is exactly how the next 20 years of your life are going to work out. That's, of course, simply not real life. But I would at least feel confident as a certified financial planner professional telling this client, look, you're in a great spot. Sure, if you want to save a little bit more and you have the capacity to save and invest a bit more, I'm not going to stop you. But don't go on the rice and beans diet, because you don't simply need to do that. You're saving 20% of your income. You already have built a solid net worth for the age of 38 years old, and you do a really good job of consistently investing. Even if you're not always seeing where that money is going, it doesn't feel like you're investing 20% of your income. That's what the data suggests. And this is what it could look like in the next 15, 20, 25 years. And then taking a look at the last line that I've got highlighted here. So even at the age of 65, they'd have roughly $6.6 million of a net worth, and that would reflect about 40 years worth of spending. So theoretically, at the age of 35, based on this projection, they could sell everything. Again, not saying that that's what we would want to do. That wouldn't be tax efficient. There's all sorts of other assumptions and things that we would be considering at the time of doing this, but that suggests that they would have nearly 40 years worth of spending, not assuming growth, inflation, etc. in their net worth. Theoretically, then that would get them to 105 years old. Again, as we get closer to retirement, so this is more for accumulators is what we're looking at here. As we do get closer, probably in your 50s, depending on when you're looking at retiring, we are going to want to run some more detailed calculations with some, we'll call it fancier software than a simple spreadsheet here, where we're really running some different analyses on stress testing portfolios, stress testing various scenarios, just to make sure that we're not missing anything, and then we have a sound retirement income strategy in place. So the overall moral of this story is these clients are doing very well. They're saving a consistent portion of their income. They don't have an overspending problem. There's no issues whenever it comes to the debt side. So the whole goal of this is to show them, hey, you guys are on track. We're going to keep monitoring this. Yes, we'll make updates if and when we need to, but you guys can spend your money in a way that aligns with your values. So whenever you do go spend money on something that you both enjoy, hopefully that allows you to enjoy it even more, knowing that you've got a good plan for the future. We're updating that plan on an ongoing basis. So as long as you're not overspending, spend the money on things that you enjoy. That's what I love so much about financial planning, and especially working with a lot of high earners like yourself. If you're still watching this video at this point, is you've done a great job. You're great at making money. You've grown in your career and make solid income. And then it's, well, should I be saving more? Because you could always save more money. There's not almost ever a time that you can't physically save more money, but it gets to a point where, is it worth it? How do you make sure that you have a plan where you feel good about the future, and that confidence in your future and confidence in the plan, because the decisions you're making today free you up to live life better and more intentionally in the present? It's the big tagline of my firm: maximize life today, plan for tomorrow. How do we enjoy our lives now, spend time with our family and friends, doing different experiences, spending money on things that we enjoy, knowing that we can continue to do that, hopefully for the rest of our life, knowing that we're on good track moving forward. And right before we wrap up this projection, I did want to share one thing that we haven't yet talked about, and that's Social Security or other guaranteed income's impact on your future retirement, and even in this projection in particular. Now, before you rush to the comments and say that Social Security is going away and you shouldn't plan for it, let's pump the brakes on that. The recent study that's come out as of April 2026 is with no action changing, which, without even getting political, both Democrats and Republicans have a very vested interest in fixing things. But even if nothing happens in 2035, current benefits would be reduced by about 17%. So instead of getting, say, $1,000 a month, it's going to be about $170 less in that example. And then if nothing still continues to change over the long run, I think in 20 years, 30 years, somewhere around there, benefits continue to get cut by a little bit more. I think at that point, they could be cut by up to 27%. Again, I don't even think that we would get to that point. I think both parties have a vested interest in getting this figured out. I'm not opposed also when clients want to plan for no Social Security, which is what we've already done. But if it is there, it will impact your retirement plan. And the reason that it will impact it so much is due to what I call your adjusted total term score. So we've already talked about what total term means, and that's your total net worth divided by your annual spending. That shows you how many years you could theoretically live on your assets, taking away most of the assumptions. But how guaranteed income, like Social Security, will impact your total term score is because of your adjusted spending. Let's just keep math really simple. And let's say that you spend $100,000 a year and you have $50,000 in guaranteed income, like Social Security between you and your spouse. Well, instead of needing from your portfolio or from your assets all $100,000 to survive and spend money on your lifestyle, well, 50 of that is already covered by Social Security. So the other 50 is the amount that you truly need to withdraw from your portfolio or other assets. So in this example, all things held equal, it effectively doubles your total term score. So what we're looking at here though for this couple is exactly that. We're going to assume, again, we're keeping everything in today's dollars, $48,000 a year. That would be combined. That could be 24 for husband, 24 for wife. In this example, we'll call it $48,000. So what we see here, even at the age of 65, that reduces their spending. That reduces the money that they're going to need to pull from their net worth or from their portfolio. So in this particular example, that now increases their total term score at the age of 65. Again, for sake of education or illustrative purposes here, we're just assuming that that's when they would take Social Security and that's the number that is correct. Their total term goes to 57. And if you remember what that was before, let's take away Social Security. We scroll back down, it's 40. So even though, Brandon, we might not be as close as we think, maybe we're even a little bit below the 25 total term target, once we look at adjusted total term due to your adjusted spending, things might look even better than you thought. Again, I'm not suggesting that you plan on Social Security being a huge portion of your retirement. Again, especially when you're a high earner, it's going to be a relatively small percentage of your retirement income anyways, but it is at least something to consider and be mindful of and understand how those impacts truly do change your retirement picture, and oftentimes for the better. If you were expecting to have a 40 total term, for example, at 65, but then all of a sudden, because of some guaranteed income, that changes it. That's nearly 17 additional years of spending because of Social Security. Again, just wanted to keep you in the loop and just show how Social Security or other guaranteed payments like a pension would impact this projection even 20 years out. As we've been talking about throughout this video, this is simply a projection. And of course, we're making a lot of assumptions along the way. So this isn't meant to be prescriptive advice. This isn't let's run one projection and check it every so often to see if we need to make changes. It's let's make it. Do we need to make any changes today? And in this particular case, not necessarily. Again, if they want to spend a little bit more, rather, if they want to save a little bit more, they can, but there aren't any drastic changes that this particular couple would need to save. So hopefully what that does is it frees them up to spend more of their hard-earned money in the present, knowing that they've got a plan for the future so that they can better enjoy life today. So when it comes to this though, you might be wondering, well, why do I still then need to work with a financial planner if things look overall pretty good? As I mentioned before, one, I guess you don't have to. You could DIY this, and some folks decide to do that. But really where the value is this ongoing nature, where we've got our plan today, we've got the projection today. 1 year from now, hopefully, we're a little bit smarter than today. 3 years from now, 7 years, 10 years, so on and so forth. As our life changes, our plan's going to get changed. We'll need to be making these updates in real time. So that's going to be one of the values. And then also, we're talking really high level today. We didn't even get into things of, well, should they be more intentional with their charitable giving and use some of those restricted stock units to donate to their favorite church or charity they're already donating money to, but can they do that in a more tax efficient way? What types of investments do they need to have? Are they too conservative in their current portfolio? Are they too aggressive in taking on too much risk? And is that going to hinder them getting closer to their goals? Should they be putting money in Roth accounts? Should they be putting money in pre-tax? Some sort of blend of both. Is that for just 2026, or does that change in 2030 or 2035? There's ongoing tax strategy, ongoing tax planning as well. So even though we've got our basic projection, try to keep things as simple as possible and feel good about where we're heading, there's still all sorts of other levers to pull, because if we can save them 10 grand a year in tax and they repurpose a portion of that to savings, that might get them to retirement or work optional even sooner than they thought. So there are just so many things that we'll still be able to work through, and then we'll go back to this projection anytime there's a major life event, or at minimum one time per year, just to see what's their updated net worth and what's their updated spending and their savings, and where do we think that's going to land them in 15 to 25 years. And most importantly, do they need to change anything today? Because if we look at this and we say, hey, you don't need to change anything, 2 thumbs up, hopefully that helps them spend more money, be more present in the moment. At the end of the day, this couple didn't need a brand new budget or some extreme lifestyle change. They needed a clear view of their numbers. Once we laid out their element scorecard, their projections in today's dollars, and even briefly discussed the impact of things like Social Security on their overall plan, they could finally see that what felt like paycheck to paycheck was actually a solid plan working quietly in the background, helping them build wealth. So if you're in a similar spot, you've got great income, things maybe feel tight, and you're not actually sure if you're on track, this is the kind of work I do for clients. There's a link in the description where you can learn more about how I work with families like this, and if it's a fit, start the process of building your own version of this plan so that you can feel confident about your future to free you up to enjoy life in the present. Thanks so much for watching, and I'll catch you in the next one.